Good morning to all of you. Welcome to the teleconferencing of today's session. In today's session we have, in today's program we have 3 sessions in the first half, which we are going to allocate for corporate management area. And in this we are going to take up MS3, that is Economic and Social Environment course. And in that particular course we are going to cover one of the topics in external sector, that is balance of payments, which is an important aspect in the context of external sector as far as the economy is concerned. First of all, let me tell you what is balance of payments. It is a systematic record of all economic transactions that have taken place between the residents of a country and the rest of the world. It is in fact composed of all receipts on account of goods exported, services rendered, and capital received by residents. Apart from that, and the payments which are made by them in return on account of goods imported, services received, and capital transferred to non-residents or foreigners. This balance of payments consists of economic current account number 1, and capital account, and the third is cash account. All this we are going to discuss in the next 45 minutes or so. Balance of payments is such an important topic because it serves as an economic barometer of the economic development of a country. So, keeping this in view, we are going to discuss all the aspects related to this particular topic. Today we have Professor Banik from International Management Institute as our resource person. Now I request Professor Banik to make his presentation. Thank you, Professor Banik.
Thank you, Professor Subayamma, and good morning to the participants. Today we are actually talking about the balance of payments and the international linkages. Now, when you talk about the balance of payments, is basically a country's economic transactions, a country's economic transactions with rest of the world. And if you overview what we are actually planning, we will talk about the categories, the flow of goods and services, which is particularly services and the capital, and how a country is actually planning to cope with the deficits that defined by the deficit in the current account, that defined by deficit in the budget part, which is the budget deficits. These are two bargaining issues in recent time in the context of USA, which is known as the famous twin deficit problem. Because before going to the details of these aspects, we will start preliminary is actually part 1, which is actually balance of payments. As we have mentioned, that is basically a country's economic transaction with the rest of the world, and on behalf of the government, central bank is basically assigned to monitor these transactions. So the purpose of a balance of payment is very clear. Measures all external financial economic transactions over a specific period of time. Now, if you see your standard accounting mechanism, if you recall your accounting, when you have a debit, you should have the credit. That's the standard technical aspects of the accounting, which is popularly known as double entry bookkeeping. So basically, balance of payments also maintains that these aspects, the currency flows, the credits, earned foreign exchange, and when you have the currency outflows, that's debit, which expend foreign exchange. Now, balance of payments categories, as I said, the categories are defined by current account, capital account, and official reserves account. So what is actually current account? Records net flow of goods, services, and unilateral transfers. Net flow of goods and services, that simply defined by exports, which is the inflows, imports, which is basically the outflows. That's your trade, or is also known as, if your inflows are higher than the outflows, that's simply a trade surplus economy. If your imports are higher than the export, that's simply a trade deficit economy. If both the aspects are basically equal, that's called the trade balanced economy. The another aspects of the current account is the services, which is also known as invisible or unilateral transfers. Now, what is actually unilaterals or invisibles? Now, invisibles or unilateral transfers, the government of India decided to give grant to the neighboring countries, or you have planned to remit funds to your relatives in some other countries. So these are actually services, including tourism income. Say, tourists are visiting in India, that's simply explains the inflows of foreign exchange. When you decide to go abroad, that's simply explains the outflows. So in the current account part, and the whole analysis is basically what we have learned so far is basically trade plus invisibles or unilateral transfers. Now, the second part of the category is the capital account. Records public and private investments and lending. So inflows are credit, outflows are debits. Now, what are those transactions? The transactions are defined by portfolios, which is known as investment made by the foreigners in the domestic economy. Which investments? There are two types of investment. With the long run, which is known as direct investments. One is the short run, that defined by investment made the foreigners or FIIs or portfolio investors in our stock market. That's known as short term or portfolio investments, and direct investment is basically those who are coming for the long term gains of the economy in terms of say manufacturing, in terms of industrialization, something like. They are basically long. So FDI or FIS transactions is basically under the categories of capital account. Now, one point to be mentioned here, so far current and capital accounts are concerned, we normally use the term the full convertibility in the capital account or full convertibility in the current account. Now, so for current account is concerned, it means that if you have the remittance from other countries or you are sending some money to your relatives, so whatever the exchange rate prevails, you take advantage of that exchange rate, which is in other words known as market exchange rate. In the Indian context, market exchange rate is defined by managed float mechanism, because there are three different exchange rate regimes. From 1947 to 1980, we followed a standard fixed currency exchange regimes, and then we followed dual exchange rate regimes. Then we followed now in recent time managed float mechanism. There is another exchange rate regime which is popularly known as clean float mechanism. So far India is concerned, we follow only managed float mechanism. So but transactions are concerned in the current account, they are basically guided by, in the Indian context, is managed float mechanism. So our current account is basically under the regime of full convertibility. It means that when you have the remittance, so for these transactions are concerned, export, imports, or unilateral or invisibles are concerned, RBI or central bank of the country may not have any role to play, whether its funds is going out or in. That's called full convertibility in the current account. In the capital account, convertibility is concerned. There are a lot of debates in the country. You might have seen in the newspaper also that Prime Minister formed a committee to see the full convertibility aspect in the Indian economy, and there are many theories on that. Somebody called it should be done immediately. There are experts they are talking about. No, it will take time. We should follow certain kind of sequencing. There are other theories that there is a problem of absorption in the economy. So if you have the free capital inflows and outflows in the capital account, there may be a problem. Funds may go out of the country. We may face the problem of what problem actually existed in the East Asian economies. So there are a lot of debates on that. So far, transaction in the capital account is concerned, and Indian economy, we have partial capital account convertibility. In other words, certain kind of transactions are basically enjoying the full convertibility. For example, FII's inflows or outflows in India, theoretically, it should be under capital account non-convertibility. But the Indian context, FII's transaction is under full convertibility, not partial convertibility. Similarly, in recent time, you must have seen the finance minister's statement in recent time that an Indian can invest in other parts of the world to the tune of per annum $50,000. So it means that if you want to invest in New York Stock Exchange or some other markets which are lucrative for you, you are welcome to invest there without any central bank's permissions. That simply explains we are also going to be globalized so far this particular account is concerned. On the whole analysis, capital account in our country is actually partly convertible, not fully convertible. Now, there are other aspects which is basically known as, or category, official reserve account. Now, the function of the reserve account measures changes in international reserves owned by the central banks. Now, when you have the inflows, say trade for example, you have the trade surplus or current account surplus. If you have the current account surplus at all, that surplus is actually transferred to the official reserve account of the country. Similarly, if you have the capital account surplus, say due to foreign investments, that simply explain which will transfer to the capital account, from capital account to the official reserve account. Now, what are the constituents of reserve account? One is basically the gold, the other is the convertible securities. Convertible securities buy, if central bank decided to, if they have the surplus, say, for example, we have about say $150 billion surplus now in the reserve account, and government or central bank or RBI must be investing these amounts in various securities around the globe. Mostly in recent time is US securities. So they are known as convertible securities. Net effects, sum of all transaction might be zero. So if you take the money from current account surplus you have, then you debit your current account and credit the official reserve account. Capital account same. If you have the surplus, you debit your capital account and transfer to the reserve account or official reserves at all. One of the important constituents of the reserve account is also known as special drawing right or SDR. Now, the SDR is basically allocated by International Monetary Fund to a particular country when you have basically problem due to foreign exchange shortage, and if the IMF feels that your shortage is genuine, then perhaps a country can use the special drawing rights. Now, how those special drawing rights are basically allocated? Depending on the country's exports and imports behavior around the globe. So if you're more globalized, if more exports or imports are significant, then SDRs are basically allocated according to the performance of the economy, and it varies from year to year. So for SDR, another aspect of SDR is basically one SDR roughly is about equals to $17. If you see our official reserve account, you can easily find out the SDR component in these aspects. So more or less on the whole analysis, we talked about categories, consist, as I said, the basic balance, accounts and long-term capital inflows, the basic aspects, emphasizes long-term trends, excludes short-term capital flows and heavily depend on temporary factors. Official transaction measures adjustment needed by official reserve. As I said, adjustment defined by you have a shortage, then you use basically that SDR in order to balance your account. Now, how do they link with the international flow of goods, services and capital? Links from international to domestic flows. Now, global linkages are basically, one is the domestic spending and production and current and capital account. Now, for example, a country's exchange rate is basically managed by fixed exchange rate regime or currency board mechanism. It means that, for example, if your US dollar is equal to $45, US dollar is equal to $1 is equal to 45 rupees, and your average shortage say about $100 in a year. In other words, you may have the current account deficits, and if you have the capital account deficit, then you should have next year $100 reserve in your account in order to maintain that fixed exchange rate, which is also known as fixed rate or currency board mechanism. Now, if you have the shortage, if you do not have $100 in the reserve account, you can approach the IMF that I have the shortage of $100 and then I cannot manage my exchange rate, which is basically fixed exchange rate. And if IMF is at all convinced that your problem is genuine, then perhaps they will provide you to use the country's SDR or special drawing rights. Now, it's not easy that they will be convinced about your whole things, but they may see they take time to see the aspects in terms of whether currency is actually distorted, overvalued or undervalued, and they strictly examine the situations. If they are not convinced, perhaps they can argue your exchange rate mechanism is basically distorted, overvalued, so you are not competitive, so you devalue the currency and then take advantage of the other exchange rate mechanism. Now, how this exchange rate or deficits, the current account, and which is the another part in the macroeconomics, you know, the budget deficits, which is basically you spend more money than you earn, so you have deficit there, and in the capital account, in the balance of payments also, your outflows are higher than the inflows, that is deficit there. Ultimately, these both deficits should be theoretically should be adjusted in accordance with the savings rate of the economy. If you have the net shortfall, then you have a problem. Interestingly, this twin deficit problem in recent time is very, it has become a strong issue now because of the US is having problem of budget deficit. They spend a lot of money, earn less or collect less or tax rates, and that simply explains they have the shortage. Now see the equations, then we will explain what is happening in USA. National income is either spent or saved. That means that you have the national income that should be spent in terms of consumptions and partly in terms of savings. Now national spending, your savings are created because your personal spending and the investments, then you subtract from 2 to 1, you get NI minus NS is nothing but the savings minus investment, which is nothing but the tax component. Tax component is actually the budget, because you earn due to that one, and if NIN is greater than NS or savings is greater than I, which implies that surplus capital spent overseas. It means that you have the capital surplus economy, you then spend overseas. In a freely floating system, excess savings equals to capital account balance. Implication: a nation which produces more than it spends, recall, a nation which produces more than it spends has a net capital outflow producing a capital account deficit. It means that if you have the savings, then you are basically spending money not in the country, you are basically producing outside the country. A nation which spends more than it produces has a net capital inflow producing a capital account surplus. A healthy economy will tend to run a current account deficit. Now, if you have the current account deficit, that simply explains you should have enough savings in the economy in order to manage both budget deficit and both current account deficits. Now, recall those identities, what we are basically now deriving. In other words, national income minus national savings is basically tax. If you have surplus tax at all, then that surplus tax will be spent in accordance with export and imports. Now you combine H minus I is the tax components and X minus is the export and M is the import. So you have the savings in the economy. What you do basically, that savings is spent in terms of exports and imports. Now S minus, since S minus I is basically the tax components, in other words, net foreign investment suppose is a positive, that simply explains that you have surplus in the capital account and this is balanced in accordance with exports and imports. Implications: if current account is in surplus, the nation must be net exporter of capital. If CA is a deficit, the nation is a major capital importer. When NS is greater than NI, the excess must be acquired through foreign trade. Now, how to improve that situation, the deficits? Raise national income related to domestic investment, increase savings related to domestic investments. Government budget and current account deficit, as I mentioned earlier, the American situations is basically current account balance, savings surplus minus government budget deficits. Incidentally, in the American context, they are having both problems with the deficit in the budget part and deficit in the current account part. Current account deficit means a nation is not saving enough to finance and the deficit. America is the case. Their average savings rate is less than 10%. In other words, on average terms, an average American, if they are earning $100, they spend more than $100, sometimes it's more than $200. It means that how do they do this kind of activities? That simply explain the major factor contributing their expenditure behavior is due to credit cards. So they spend more money, they earn less, and foreigners is actually invest in those securities of the banks, and in turn the banks are using those as the credit tools and giving to the consumers. And if surplus means the nation is saving more than needed to finance its and deficits. Now, how to cope with the current account deficits? Possible solution unlikely to work. Current currency depreciations, protectionism. Yeah, if you have that kind of problem, you protect. You basically, the so-called import substitutions. You protect the foreign goods, impose tax so that people are consuming the local productions. Or if you depreciate currency or devalue the currency, that means that you will be competitive and then sell more goods and services to other parts of the world. But depreciation ineffective because it takes time to affect trade. People argue is a J-curve effect. It's basically declining in currency value will initially worsen the deficit, but before improvement, but then you will adjust, then you can see the J-curve effect will be a positive. It's a popular hypothesis or theory in defending why country is actually devalue their own currency. Now, coping with the current account deficit, it means that trade barriers use tariffs and quotas. Because you spend more money by importing goods and services, now you are basically patronizing local industry to produce more to remain in the market. Results most likely to reduce both export and imports. One protectionist solution would place limits on or eliminate foreign ownership leading to capital inflows, stimulate national saving, change the tax regulations and rates. Current account deficits, neither bad nor good inherently, because we will now explain the situations in the context, which is very interesting. Since one country's exports are another country's imports, it is not possible for all to run a surplus. Deficit may be a solution to the problem of different national propensity to save and invest. Now, exchange rate regime. I have already mentioned fixed exchange rate regime. This exchange rate central bank holds constant the price of foreign currencies in terms of domestic currency. It holds this buying and selling foreign exchange at the fixed exchange rate. It has to keep reserves of foreign currency for that purpose. And the other is the currency board mechanism as followed by Singapore, for example. The argument says they have about 100 years of reserve so far their current level consumptions are concerned. In other words, whatever the currency exchange rate they are maintaining, if they are maintaining according to this current level of consumptions, they can survive with the exchange rate reserve until up to 100 years of time in future. On a floating and flexible exchange rate, the exchange rate may change from moment to moment. In a system of clean floating, the exchange rate is determined by supply and demand without central bank intervention. Under managed float mechanism, the central bank intervenes by buying and selling foreign exchange in an attempt to influence the exchange rate. We can see there's a BOP in there. Okay. Now at the right is the stage basically we are talking about if America's problem of twin deficits, which is current and capital account, and why they are having that kind of deficit, what are the sources of fundings, and what are the implications. Now, since 1985, the country is having a problem. They have total deficit of $6 trillion in both budget and current account. Theoretically, this deficit should be generated from their own economy. Since average American savings rate are always not at satisfactory level, so what they do basically, they use the federal bank bond globally and then collect funds from around the globe. And most of the surplus nations, for example, China, Japan, most of the economies are basically East Asian economies, even India also, invest in US bonds. Ultimately, these bonds are going back to America because America is borrowing with the help of these papers or securities. Ultimately, their account is balanced. Now, there are many arguments on that, why things are happening. There are two major arguments. One is basically the present Federal Bank chief, Mr. Bernanke. He argued nothing wrong in borrowing from other economies. Simply you consider a global village, and if American economy is vibrant and strong, no matter how much deficit we have in the current account on or budget part, since we are lucrative for the foreigners, they invest in our bonds. There's nothing wrong with that, because we are the ideal location from them. There is another theory recently developed by Raghuram Raman, who is a celebrated Indian economist, that historically developed economies are basically investing in developing economies. Now you have the opposite term, because now developing economies are basically investing in developed economies. In other words, the financial sector of those economies are very strong, and so they invest in American bonds in the opposite directions. Interestingly, there are some East Asian economies are basically taking advantage of that situations. For example, now assuming no country is basically investing in American bonds, theoretically, then American currency dollar should depreciate. If American dollar is depreciating, what will happen? Then manufacturing within America will be competitive. So more employment will be generated in America. Then America will not be importing goods and services from East Asian countries, which is a positive part of the American context. On the other extreme, if you see the interest of China, for example, or Japan, for example, if America's currency is depreciating faster than their currency, what will happen? China will never be competitive because by selling goods and services to American economy, because American currency is depreciating. Now, basically, it is now the responsibility of the China, Japan, Taiwan, or Singapore to defend America's exchange rate, so that American dollar is not further depreciating. If it is depreciating, they cannot sell their products, so they invest in American bonds so that currency is basically American theoretically should be appreciating, so that they can sell goods and services in an American economy. In other words, it's not the responsibility of the Federal Bank of USA to defend their own currency. It is the responsibility now for China, Japan, and other surplus producing nations to defend American exchange rate. It's very interesting. Thank you very much.
Okay. Thank you, Professor Banik. With this, I just summarize what so far Professor Banik has discussed. As he said, the balance of payments is one of the important aspects of the economy as far as external sector is concerned, and it reveals the various aspects of a country's international economic position. It presents the financial position of a country when we compare with the other countries. It also helps the government in formulating the monetary and fiscal policies on one hand, and on external trade and payments on the other. And these are the aspects which have direct or indirect impact on the business operations, which as managers you must understand to run the business. With these words, we come to the close of this session, and the next session will follow at around 12 o'clock. Please thank you.